When building a portfolio to retire on dividends, you really want to build it around a core of blue chip stocks that meet certain set criteria, namely a durable defensive business model that you can count on through thick and thin and through all sorts of disruption, a strong balance sheet that never makes the management choose between paying out and growing the dividend and keeping the company on solid financial footing. You want a high enough yield so that in aggregate you're building a portfolio that can meet your income needs comfortably with a margin of safety in retirement. But at the same time, you want that yield to be well covered by cash flows, so you're not running at risk of a dividend cut. And finally, you want that dividend to grow at a rate that meets or beats inflation over time, so your purchasing power, your standard of living can be sustained over the long haul. Now, a great way to get all these in one stop is investing in ETFs like the Schwab US Dividend Equity ETF, and maybe an MLP ETF like the Illyrian MLP ETF or the Global X MLP ETF. And then maybe you can go into infrastructure or real estate with funds like the Reeves Utility Income Fund, UTG, or perhaps Cohen and Steers has some good funds like RQI for real estate. You can bundle those together, get a good yield, good diversification, and pretty solid long-term dividend growth. Of course, the total return aspect, and you're going to take on a little bit of leverage to do that too with some of these funds, is not as great. And so that's why I pick individual stocks. I think I can get even better risk-adjusted yields, better dividend growth, and certainly better long-term total returns. And so in today's article, I'm going to share 3 of my highest conviction retirement stocks that if I could only pick 3 to retire on and I had to just be focused in these 3 and maybe complement it with a fund like SCHD, these are the 3 I would pick. So the first one shouldn't be any surprise to you. I've talked about it a lot. Enterprise Products Partners issues the K1. So if you don't like that, there are other alternatives like ONEOC, which is a pretty good 1099 substitute, or maybe even, an ETF like the one I mentioned earlier, AMLP or MLPA. But it's great because it has around a 7% forward-looking yield. It's covered about 1.7 times by distributable cash flow. Over 80% of its cash flows are commodity price resistant, contracted to long durations with inflation-linked escalators. It has a phenomenal track record of generating over 10% returns on invested capital through all sorts of energy market and economic environments. So very defensive and durable. Has the strongest credit rating in the midstream space at A-. Credit rating from S&P, very low leverage ratio of about 3.1 times. About an 18-year weighted average term to maturity on its debt. Significant liquidity, so no concerns there. And on top of its distribution of nearly 7%, that's covered about 1.7 times with distributable cash flow, it's growing its distribution at a mid-single digit 4 to 5 to 6% annualized rate, and it should continue to do that moving forward. In fact, it's nearing a cash flow inflection point where the company is going to have a lot of growth projects coming online, which means its growth capex is going to plummet at the same time as its EBITDA is going to soar, leading to significant additional free cash flow, and as well as significant capacity on its balance sheet as its leverage ratio drops due to all that EBITDA coming online. And that's going to create an environment where management can then have a choice what to do with that cash flow. It can make an aggressive investment, acquisition, which has a very impressive track record of making good capital allocation decisions there to further drive growth, to further boost distributable cash flow per unit, and ideally improve the distribution accordingly. It can buy back units aggressively, which will create intrinsic value per unit by reducing the units outstanding and potentially create additional capacity to grow the distribution at a faster rate since the payout ratio will be coming down with fewer units out there. It can also simply just use that cash flow to pay down debt, and maybe it'll pursue a much lower leverage ratio. I'm not sure why it would, but it could make that choice. It wouldn't shock me if it did. Management's pretty conservative, but I think the odds are that they're going to mainly be buying back units, assuming the units are attractive, and investing in growth opportunities, and combine that should lead to faster distribution growth. So that should be a catalyst for the unit price as well. Okay, what's my second pick? Blue Owl Capital. Now it's an alternative asset manager that's diversified across the private credit, the general partner solutions, and the real asset spaces. And its direct lending, private credit business is about 50% of its assets under management. That's been its main bread and butter growth engine so far. Has a phenomenal long-term underwriting track record with like a 5 basis point annual net loss ratio or something like that, very low. So that's a pretty proven business. The market is a little bit nervous about it because it makes up 50% of assets under management, and there are concerns that private credit may have gotten oversaturated, could be economically sensitive in a downturn. But between Blue Owl Capital's track record and the fact that the vast majority of its investments are in fairly defensive businesses with senior secured positioning in the capital stack, gives me some confidence, especially because it's such a large and well-diversified business that shouldn't crater too badly in a downturn. General Partners business has been doing very well. Those are just stakes in other alternative asset managers that have done very well for them. And then finally, their infrastructure real asset business is one that's really exciting. They have a triple net lease arm that's pretty defensive, obviously, but grown remarkably well in recent years despite interest rate headwinds for REITs. And then the other arm of it is where the real excitement is. It's their digital infrastructure business, primarily focused on building data centers for hyperscalers in the AI boom. And that should grow very fast in the coming years and really drive strong continued growth. And as a result, management is confident in growing their earnings per share at about a 20% CAGR moving forward, which when you combine with a 5% dividend yield, very attractive total return profile, and really combines a nice yield with growth that should crush inflation moving forward. All underpinned by a very strong investment grade balance sheet with no major debt maturing until I think 2031 it is, and some of its debt turned out several decades into the future. So a lot to like about Blue Owl Capital. Finally, there's a REIT there, and there are several honorable mentions that I could pick from, ranging from WP Carey to, I mean, even Easterly Government Properties has a lot going for it, but the track record there is just too small and the balance sheet's not strong enough. I have to go with Realty Income because WP Carey recently had a dividend cut, which kind of puts a foul taste in the mouth again. We're thinking about this from a income for retirement standpoint. And again, if we're concentrating in 3 stocks, I want something that's pretty well diversified. And it's hard to get more well diversified than Realty Income with thousands and thousands of properties in its portfolio, spread out geographically, an A- credit rating, which is one of the very best in the REIT sector, a 3-decade dividend growth track record where it's grown at a rate that's beat inflation over that time. Long-term total returns have been attractive. Yes, in recent years, growth has slowed some, total returns have slowed some, but that total return and growth downturn are largely due to interest rate headwinds. And there is some effect of the law of large numbers, but of course you're getting safety with that too. So you have to trade that off. The forward dividend yield is nearly 6%, trades at an attractive price to NAV relative to its history, and it's expected to grow its dividend at around a 4% CAGR moving forward, so it should beat inflation. So again, this is probably the least exciting of the 3, the lowest returning of the 3, but it's also probably the most rock solid and safe in a downturn scenario because of its triple net lease and structure and its balance sheet. So there you have it. Between these 2, you have a well-diversified portfolio of assets. You get a nice yield of about 6%. You get strong inflation-beating growth and high-quality management teams, high-quality business models, and you can even supplement this further with, say, a fund like the Schwab US Dividend Equity ETF to get more broadly diversified exposure across the economic spectrum. So there you have it. Those are my 3 picks: Enterprise Products Partners, Blue Owl Capital, and note that's ticker symbol OWL, not ticker symbol OBDC, which is a BDC. This is an alternative asset manager that manages BDCs like OBDC. So keep that in mind. And then a REIT like Realty Income. Now, of course, if you want to avoid these or you want some alternatives to further diversify, along with EPD, there are a lot that I like, Energy Transfer, MPLX, Western Midstream, Oniok is great, Enbridge is great, TC Energy is great. A lot of good options there. Even PAGP or PAA, Plains All American or Plains GP, depending if you want the 1099 or the K1. Those are solid additions as well to further diversify. And then on the alternative asset management space, I think that Brookfield Asset Management is another good option. A ticker symbol BAM, I just don't think it's quite as attractively priced as OWL is. And you can further expand that as well if you want infrastructure plays like Brookfield Infrastructure Partners, Brookfield Renewable Partners, or if you want to go into the BDC space, there are a lot of blue chips out there that pay good dividends. Then in the REIT space, again, WPC gets an honorable mention. I think RQI gets an honorable mention. DEA gets an honorable mention. There are several others out there that I like as well. So anyway, hopefully this added a lot of value to you. If it did, again, like the video, help it to get better distribution. It'd mean a lot to me. Make sure you subscribe to the channel for future content like this. Thank you very much. I'll see you next time.